Hi ladies and gents, welcome to another podcast. We're going to be looking at depreciation. It's going to be the first of 5 lessons on depreciation, so there's quite a lot that we need to cover. We're going to cover the most basic form of depreciation first, which is called straight line, and it's probably the easiest one of the lot to do. Okay, first of all, what is depreciation and what causes it? Well, depreciation accounts for the loss of value of a non-current asset over time. So I think we all probably know that if your mum and dad buys a car, for example, a year later that car is going to be worth a little bit less. And it's called a provision for depreciation because it's an amount from profits that are being put aside in a company's accounts to cover a future liability. So we know that the car's lost value, we don't know how much value it's lost, but we can have a pretty good guess. So we call it provision account, we put some profit on one side, and that's a key thing to remember because in the provision account it's always a credit entry because it's profit put on one side to allow for the fact that our non-current assets are depreciating or decreasing in value, and at the appropriate time, i.e. when we actually sell the asset, we actually do something with that depreciation and work out whether we've actually depreciated the asset by the right or the wrong amount, and at that point we actually know how much loss we've made on it. Okay, two forms of examples on this. One's a straightforward example of depreciation, and that's when an asset falls in value over time and we expect it to be worth nothing when we sell it. And the other type of depreciation is where we actually expect to be able to sell the asset for a certain amount of money. Well, the first type of depreciation then that we're going to look at, straight line, and here we've purchased a car for 20,000 and the company has a plan, and the plan is they are going to depreciate that asset by 10% per year. It may also be written in an exam question it's going to be depreciated over 10 years, okay, and we'll look at how we do it either way. If you're told it's 20% a year, all you need to do is to find 10% of 20,000, that's 2,000, so that's pretty straightforward, nice easy example. If you were told it was going to be depreciated over a number of years, you would do the amount we bought it for, divide it by the number of years, in this case 10, and we come up with the same answer. It's going to be £2,000 worth of depreciation every year. How's that going to look in a provision for depreciation account? Well, the first thing is we're going to put an expense straight into the income statement. So if we're putting an expense into the income statement, we're going to make a debit entry in the income statement, and therefore what we're going to do is put a credit entry into our provision for depreciation account. So some of the profit in the income statement is being reduced, and that profit effectively is being put in as a credit entry in the provision for depreciation account. And it's pretty straightforward with straight line because all we're going to do next year is at the start of the year, we're going to have $2,000 worth of depreciation brought forward. So $2,000 of last year's depreciation is kept in the accounts, and we're going to add to that an additional 1 year's worth of depreciation, $2,000, and therefore at the end of the year, we've got $4,000 worth of depreciation in total. We carry 4,000 forward, and at the start of year 3, we've now got a total of $4,000 worth of depreciation in the accounts. How's that going to look in the statement of financial position? On the statement of financial position now, it's slightly more complicated than what you've done in the past, because in the past, we assumed everything was at cost. But what we need to do for a company where there is depreciation is we need to put the accumulated depreciation at the end of the year in as accumulated depreciation. Accumulated is just a difficult term for the total of all the depreciation to date. And then what we do the cost, take away the accumulated depreciation, gives us what's called the carrying amount, or the value that we think our car is now worth. And when we do when you look back at some old exam papers, you'll see it not called the carrying amount. The old term was net book value, which you don't want to confuse with net realisable value. So if we look at the second year, for the second year, we've now got 4,000 total depreciation in the accounts. So our accumulated depreciation is $4,000, and therefore our carrying amount, or the value we think that car's worth, is $20,000. Take $4,000 equals $16,000. And just in terms of the journal entries, these are very, very simple. Okay, for each year, we put in our 2,000 expense that appears straight in the income statement, and we put an extra 2,000 into the provision for depreciation account. So this 2,000 is the same depreciation that appears in the T account. The other one appears as an expense in the income statement, and for year 2, we just make the same entries. Okay, what I would suggest that you do now is you have a quick go. I've done a similar question as one of the 2 questions you need to do as your homework, and have a quick go at doing that depreciation. At the end of the homework, fill in the table to say how comfortable you feel with this topic. Okay, so I pause the video now for a few minutes and have a look at doing that question. Okay, in the real world, there's a bit of a complication because we have something called residual value. Residual value may be the scrap value or the amount you think you can sell your car for at the end of its useful life to the business. And what we need to calculate first, before we can calculate how much depreciation, we need to calculate a term called the depreciable amount. The depreciable amount is very, very straightforward. It's the original cost of the asset, take away the sale value, and that gives us the amount of depreciation, or the amount we need to reduce that asset's value by over its useful life. So we've got an example here. Firm buys a machine for $28,000. They're going to be able to sell it for $3,000 at the end of its useful life, and we need to calculate the depreciation. So first of all, we calculate the depreciable amount. Okay, that's pretty straightforward. 28,000 take away 3,000, $25,000, and we need to do that depreciation over 5 years. So for each year, we need to do 28,000 divided by 5 years. That should be 25,000 divided by 5 years, and that gives us $5,000 of depreciation per annum. And then the journal entry is going to look the same as we've already done. So we'll have 5,000 depreciation appear in the income statement, 5,000 being added on as a credit entry in the provision for depreciation account. Same for the following year. Okay, and then the provision for depreciation account. We first of all put in our 5,000 depreciation for the first year. Okay, balance carried forward. The amount that's going to appear in the income statement, in the statement of financial position, is going to be 5,000. In the second year, it changes around very slightly because in the second year we have a balance brought forward. We've already got $5,000 worth of profit put on one side. We're going to add another $5,000 worth of depreciation this year. So the total depreciation at the end of the year is now going to be $10,000. Okay, and then looking down here at the statement of financial position, at the end of the first year, okay, just notice here, by the way, that the cost value still is 28,000. We don't use the depreciable amount there, we use the cost value. We have 5,000 depreciation in the account. We think it's going to be worth 23,000. And in year 2, we've now got 10,000 depreciation as a balance carried forward. So the total accumulated depreciation is going to be 10,000. 28,000 take away 10,000 is 18,000. So the value of our non-current asset of motor vehicle on the 31st of December 2015 is $18,000. Don't forget to do the second question. Okay, good luck with that, and hope you do okay.